Hello there, and welcome to Project Business Basics, designed to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our show. I'm Archit Janarkar, and I'm your host. Today, we're going to be talking about options. Options are a specific method of buying or selling securities. We discussed securities earlier, and securities are basically any financial instruments that can be bought and sold. Now, to figure out what options are, let's use a tangible example. Let's say that you want to buy a house. Now, this house is currently valued on the market at $200,000, but you think that the housing market is going to go up. So you think that the house's expected value exactly 1 year from now is going to be $250,000. Now let's say though that there's a level of uncertainty in your hypothesis. You think that it's going to go up to $250,000, but you're worried about the risk that's involved in it. You think there's still a reasonable chance that the house's value could even fall to $150,000. So what you do then is you write a contract with the seller of the house, and you say to the seller, look, I'll pay you $10,000, and in return, you give me the option of buying the house at $180,000 for 1 year. So what that means is if your house's value ends up going above $200,000 to $250,000 within the next year, just like you think it will, you get the benefit of going to the seller and saying, look, we wrote this contract, I paid you $10,000, and I'm going to execute my option, which then means that I can buy this house from you for $180,000 instead of the higher price the market is currently assigning of $250,000. And what this does is it gives you the benefit of buying the house for a lower price than what you would have paid had you just bought it outright. Now let's say though that the house's value falls to $150,000 in the next year. Well, you're never under any pressure to buy the house. The option is called an option for a reason. You only end up losing that $10,000 you paid to hold the option contract. Now, when we talk about options, there are two types of options. There are call options, and then there are put options. Now, if you buy a call option, that means that you can buy, say, a stock at a certain price as long as you pay a premium and you then execute your option before its expiration date. With this house example that we used earlier, the house is the asset that you're trading and you're buying a call option for it. You're paying for the right to buy the house at exactly $180,000 within the next year. And the price then that you have to pay for this situation is called the premium, or that $10,000 that you ended up paying to the seller. Now, the opposite of a call option is a put option. With call options, you're given the right to buy an asset at a specific price. If you use a put option, then that gives you the chance to sell a stock at a particular price as long as you pay a premium. Now with call and put options, you're relying on two different things to happen. If you buy a call option, then you're hoping that the company whose option you're buying, you're hoping for its stock to go up. Now let's take AT&T for example. Say you buy a call option and it has an expiration date exactly 1 week from now. Let's say though that AT&T has earnings tomorrow. So you think that AT&T is going to have good earnings and the stock price for it is going to go up. So you buy a call option with the price of $30, which is where AT&T is roughly trading right now. And you pay some premium for it, let's say 50 cents per share. And with options, you always buy or sell options in terms of contracts. One contract is 100 shares. So I buy a call option for one contract of AT&T for $30, and then I pay $50 to buy this one contract. Why 50? Well, the premium was 50 cents per share. And if I'm buying one contract, that means I'm bargaining for the chance to buy 100 shares. So 100 shares times 50 cents per share is $50, which is the premium that I'm paying. Now let's go back to the option. Say earnings are released and AT&T's stock price jumps up to $33. Now you've paid $50 for this option, and then you choose then to exercise your option. So you can buy 100 of AT&T shares at $30 even though AT&T stock is currently trading at $33. What does that mean for you then? Well, if you bought those shares at $30 and now they're trading at $33, you can sell those shares you just bought for $33. Ultimately, then what's your profit? Well, you make a profit of $3 per share, or $300 minus that premium you paid, which was $50. Or you can then choose to hold AT&T shares if you think that they'll go up even more in the future. Essentially, call options are giving you the chance to buy an asset for a price that's lower than its market value. Now, put options, though, work in the opposite way, and they bank on the stock price falling. Let's use an example of buying one contract of AT&T shares at a price of $30 with the same 50-cent premium, except now we're talking about put options, which means that you have just bought the right to sell your shares at $30. Now, previously, you had bought 100 shares of AT&T for, let's say, $20, and then earnings come out negative for AT&T tomorrow, and AT&T stock price falls from $30 to $27. What you can then choose to do is you can then execute your put option and sell your 100 AT&T shares at $30 instead of the $27 per share that they're currently selling for on the market. And the benefit to you here is that you can sell a stock for a price that's higher than for what it's selling at in the market. Now let's break down the parts of an option. Whenever we look at an option, in most situations, it'll appear as a line of data. So let's look at it piece by piece. The very first part of an option is the security you're trading. In other words, it tells you what stock this is an option for. Let's use our AT&T example. It'll have AT&T's stock symbol, the letter T. Then after the stock symbol comes the expiration date. Let's, for theoretical purposes, use an expiration date of July 31st, 2020. That means whatever option I'm looking at, in order for it to be executed, it must be executed on or before July 31st. Now the next part of reading an option is the strike price. And the strike price is essentially what price I want to buy or sell the stock at. Going back to our AT&T example, our strike price was $30 in both the call and the put scenarios. Then next, we have to know the option type that we're buying, and the option type is just going to be whether it's a put or a call. And now finally with an option, we have a premium, which is how much you pay in order to hold the option. Let's say that someone out there was willing to sell me one contract of AT&T shares at a strike price of $30. I'll need to pay them something in order to entice them to agree to the deal, which is why the premium exists. And you may be wondering, what's the benefit for this other person to engage in the options contract? That's a good question, but that's where options can get complicated super fast. A common way to make money from options is through buying what are known as option spreads, and we'll cover those at Project Business Basics in the future. But for now, we just want to keep it simple initially. That way we're not throwing too much information at you too quickly. Okay, let's briefly recap. Options come in two types, a call or a put. A call is a hypothesis on your part that the stock or asset involved is going to go up in value, and a put is your theory that the asset's price is going to go down. And what options allow you to do is you pay a premium to someone, and it allows you to either buy or sell X number of contracts of an asset on or before an expiration date. I hope you enjoyed that episode and learned something from it. If you're looking for recommendations for good investing and business books, I encourage you to check out the Project Business Basics blog and also sign up for the Project Business Basics newsletter. You can do all this through the Project Business Basics website, which is businessbasics.online. Also, make sure to check out our social media. We're on Instagram and Twitter with the username at PROJBIZ Basics. If you enjoyed the video, then please like and subscribe to our channel for more content. I'm Archie Janarkar. This is Project Business Basics. Thank you.